Banks are tightening lending, making it harder to get a mortgage. What impact will this have on the housing market as we head into the next half of 2020? At a time of historically low interest rates, banks are requiring higher credit scores and higher down payments for people to get approved for a mortgage. At the end of this video, I'll give some insights as to why this won't hurt New York as much as other parts of the country. I'm Tom O'Byrne, real estate agent with Douglas Sullivan Real Estate, the #1 brokerage in New York. I help people buy and sell, and I make videos on the New York City and Long Island real estate markets, as well as the issues that affect them. Hit subscribe to stay up to date. Hit like if you like this video. Thanks for watching. So mortgages are getting harder to get, and yet the number of prospective home buyers rose again in the final week of May. And this is made even more significant when you realize that this number is higher than it was in May 2019. An index tracking the weekly volume of mortgage applications to buy homes increased 5% last week, seasonally adjusted, and was 18% above its level during the same period in 2019. This marks the 7th week running that the Mortgage Bankers Association metric jumped. The third week of May saw a 9% gain, while the week prior saw a 6% rise. We were optimistic to see mortgage applications on the rise, and it obviously paid off. To see that they are up year to year as opposed to just week to week during the pandemic is definitely good news. That being said, Joel Kahn, K-A-N, MBA's executive at the helm of industry forecasting, cautioned that the upward trajectory of MBA's purchase index may not continue much longer. He said in a statement, "There are still many households affected by the widespread job loss and current economic downturn. High unemployment and low housing supply may restrain a more meaningful rebound in purchase applications in the coming months." I personally think supply will have a short-lived effect on the market. I think the low inventory could be a boon for sellers in New York in the beginning of the recovery, causing higher prices, just as it has in large cities throughout the country that have opened before New York. But ultimately, I tend to agree with the projections that predict supply will catch up to or exceed demand 6 months out, especially with historically low interest rates. But while all this is going on, major banks have moved to tighten standards on home loans, and the market for unconventional home loans has largely dried up. Although low interest rates had earlier led to expectations of a surge in mortgage lending, the volume of mortgage refinancings has not risen significantly, although loan applications for new home purchases have continued to rise. Furthermore, mortgage rates are about 1 percentage point higher than expected given Treasury bond yields, another reflection of tightening in the mortgage market. Let's take a look at JPMorgan Chase, the nation's 4th largest home loan provider. Back in April, JPMorgan Chase raised its borrowing standards on home loans and suspended home equity lines of credit. JPMorgan's decision to back away from mortgage lending, along with similar moves by other prominent banks, could have negative consequences for the housing market, people are saying. Their actions also come at a time when non-bank lenders, which now provide a majority of home loans, don't have access to Federal Reserve funds and may not be able to absorb a flood of defaults. We're not expecting a lot of defaults happening over the next 18 months because more people are living without a mortgage, and more people now have more equity in their home than back in 2008. So because people have so much equity in their home and they're not going to be underwater mortgages, we're just not expecting a flood of defaults. Home buyers seeking a mortgage through JPMorgan must now have a credit score of at least 700 and must put down 20% of the total purchase price. And they're not alone. Other major loan providers have taken similar actions. U.S. Bank increased its minimum credit score requirement to 680, and Wells Fargo said it was restricting its jumbo loan program. Wells will now only allow customers with at least $250,000 in liquid assets to refinance, according to the Wall Street Journal. This was a move designed to eliminate all but the wealthiest potential home buyers. Now, refinancings aside, I don't think the mortgage tightening will necessarily impact New York City as much as other parts of the country. And the reason for this is that over 70% of apartments in New York are co-ops. And co-ops have a board approval process. And co-ops already want people to have a minimum of 20% down in order to buy in. So a mortgage industry move to require 20% across the board for mortgage approval won't affect sales in co-ops as much, especially when you consider that New York City co-ops are known for having high standards when it comes to the financial health of their residents, and they're already requiring 20% down into the mortgage. I'm about to wrap this up, but before I do, let's talk about interest rates. Last week, the 30-year fixed mortgage rate for conforming loans of $510,400 or less was 3.37%. This was an all-time low for MBA's weekly survey, which accounts for 75% of the U.S. residential mortgage and dates back to 1990. This was a drop of 5 basis points from the week prior of 3.42. Jumbo rates also dropped 5 basis points to 3.66%. But anecdotally, I can tell you that right now, based on conversations that I've had with mortgage industry insiders, jumbo mortgages are few and far between right now, but that may all change as New York begins to open up. We'll wait and see. Banks are in the business of lending, not spending. I think the conversations will change as New York goes through its opening phases. Thanks for watching. I'm Tom O'Byrne, real estate agent with Douglas Sullivan Real Estate. I help people buy and sell, and I make videos on the New York City and Long Island real estate market. Thanks for watching. Hit subscribe, hit like, and have a great day.